Hello Mortgage Coaches, this is Jacob with Mortgage Coach Support. This video is to show you a couple of the new features that we've recently added in the assumptions section. A couple of the notables are we've added some additional fields to help you with refinances, and we've added the new MCC tax credit that will be available for first-time home buyers. So I'm going to show you how to do those right now. So anytime we're going into a refi, you'll notice that on the assumptions page here, the first one, we've added two additional fields now. So we've always given you the place to put in your property value and your monthly mortgage payment. Let's say the property value is $350 right now. Now we've given you a new field for the original appraised value. And what this one is for is the only thing that calculates off this is going to be the MI cutoff. So we want to capture what it was when they took out the loan so that we can base that LTV cutoff against the original appraised value instead of today's value. Now keep in mind, this won't change any of your net worth figures on the report. This is specifically just for MI cutoff calculations. Now the next field we entered is called the total payoff amount. Now this one's really cool because until now in Edge you actually had to modify the current balance of a loan to reflect what the payoff is. You don't have to do that anymore. When you're in the next screen over here and you're developing your loan scenarios, or your current mortgage scenario I should say, let's say they took us out at 280 and they got it at 5% on a 30-year term, you can see that Edge automatically calculates what the remaining balance should be. But oftentimes this is not going to be what their payoff is. You know, they're not going to close the loan for another 30 days, so they're actually going to have a little bit less of a payoff. So maybe this one would actually be 278. So where I'm going to put that 278 is right back in here. So I'll put my 278, 1, 2, 3. Now what this does is this calculates into your cash to close. So when we're looking at the new loan having to pay this one off, we're using this payoff amount rather than the current mortgage amount. So keep this in mind, guys. If you're running into any issues with your cash to close, try using this field. It's going to make it a lot easier for you. Now the next thing I do want to bring your attention to is the MCC tax credit. Now the MCC tax credit is a mortgage credit certificate, and what this allows you to do is it allows the first-time home buyer to write off a certain amount of their interest per year up to a cap. So what we've done is under the tax credits field here, you'll notice that you can now put in the annual MCC tax credit percentage. You want to check with your state guidelines or state programs. Usually it's about 30% of the interest per year can be written off, and it usually has about a $2,000 cap on it, so they can't credit more than $2,000. But again, you want to refer to your local guidelines. They are different in each state, so you want to make sure that these caps are correct for you. But once you've got it in there and you hit OK, that's going to show up in the tax benefit line. So the tax benefit line is now available on the total cost analysis and the rent versus own. So if I also put a tax bracket in here, my tax benefit line is going to show the tax benefit from not only the interest, the mortgage insurance, and the property tax they're paying every year, but they're also going to have that MCC tax credit tacked onto that. So you'll see that your tax benefit is substantially higher now for first-time home buyers. If you have any questions about either one of these functions, please do send us an email over at support@mortgagecoach.com. We'd be happy to help. Thank you very much. Bye-bye.